A promissory note. Promissory note is evidence of a promise to pay. It's a financing instrument that is evidence of a promise to pay a specific money amount to a specific person within a specific frame of time. The promissory note must be signed by the borrower. It must be signed by the borrower and is actually evidence of the borrower's obligation to pay. The payee is the person lending the money. The payor is the person who promises to repay the funds. Different types of promissory notes. Sometimes they just call them the note. A straight note is what's called an interest-only loan. It's only for the interest. A fully amortized loan is also called a self-liquidating loan or a self-liquidating note. It's designed to pay off the entire balance. If you get a 30-year fully amortized loan or self-liquidating loan, at the end of that term, the whole thing is paid off. Partially amortized, these are known as balloon payments. They're only partially amortized for a shorter period of time. And negative am, that means that the payment amount was not sufficient enough to cover all the interest, so that amount gets added back onto the top of the loan.